So, last time I started to talk about shadow banking, and we started to look at this first example of shadow banking, asset-backed commercial paper, and we looked at that in comparison with regular banking. In asset-backed commercial paper program, so one similarity is that the issued securities called asset-backed commercial papers are basically short-term discount bonds with time to maturity of 1 day, 5 days, 1 week, 1 month, maybe 3 months, but not 1 year. So from the investor's point of view, investing in asset-backed commercial papers, if they are safe, investing in them is pretty much like investing in deposits or certificates of bank deposit. By issuing such short-term bonds, long-term assets such as loans, receivables, and mortgage-backed securities are funded. So it is banking. Okay, long-term assets are funded by short-term money from investors. So it's relying on these investors keep investing in these asset-backed commercial papers. Now, ABCP program is different from regular banking in several respects. First, it is not the sponsor bank. It can be Barclays. The sponsor bank can be Barclays or Citibank, some commercial bank. But unlike regular banking, it is not Barclays that does lending and borrowing. It is this Conduit, a subsidiary paper company, Conduit, that does lending and borrowing. Also, ABCPs are not insured by deposit insurance, and the sponsor bank is merely a shareholder of the Conduit. So as they are, ABCP programs are asset-backed commercial papers, ABCPs are not safe enough for investors. Okay, remember, this sponsor bank is just a shareholder of this subsidiary company, and they have limited liability. So the commercial bank, the sponsor bank, can provide liquidity guarantee so that if the Conduit has problem in rolling over the ABCPs, if Conduit has trouble in selling newly issued ABCPs, then the sponsor bank, Barclays, steps in and buys newly issued ABCPs so that the maturing old ABCPs will be fully reimbursed. Yeah? And the last difference is that asset-backed commercial paper program is off balance sheet, so the lending and the borrowing is done outside the sponsor bank's balance sheet, and therefore it is less subject to regulatory capital requirement. So this is how it is shadow banking. Let's consider some commercial bank, let's say Citibank, and let's say the current regulation requires 8% capital, 8% equity. So let's say this bank lends 100 billion pounds of loans, and 8% capital requirement says that at least 8%, at least 8% should come from equity holders, shareholders. Okay? So if the bank wants to lend 100 billion pounds, at least 8 billion pounds should come from the pockets of equity holders, shareholders. And only 92 billion pounds can be borrowed from depositors. For regular companies, for non-financial companies, if the leverage is too high, if the company is borrowing too much, investors would require very high interest. Okay, if the company is, because high leverage makes the company risky. So for non-financial companies, if the company is borrowing too much, then investors would require very high interest. or maybe investors wouldn't lend at all. But for banks, it's different because banks have both explicit guarantee and implicit guarantee. Most of the deposits are insured by public deposit insurance scheme, that's explicit guarantee. And also if the bank is very large or systemically important, the probability that the government bails out this bank in the event of bank failure is very high. So for banks, even if the leverage is high, investors tend to lend to the bank for a very low interest rate. And for banks, the profit is the difference between their interest revenues from these loans and their interest payments to the deposits. So banks have incentive to expand their lending and borrowing as much as possible. So that's why the regulators say, okay, banks, you should have at least this much equity. Okay? And this, by the way, in the context of banking, equity is also called capital. So the capital and equity are the same in the context of banking. And the regulators say, okay, banks, you should have at least 8% equity. And this serves as a buffer of the potential loss, making the bank safer. And also, as we studied in week 5, equity partially solves potential adverse selection problems and moral hazard problems of banks because having their own money at stake, shareholders tend to become more cautious about risk-taking and monitoring of the bankers. Now, suppose the bank wants to expand their lending and borrowing. Suppose the bank wants to lend 125 billion pounds of loans. 8% of 125 billion pounds is 10 billion pounds. So that means that the bank should hold at least 10 billion pounds of capital. 10 billion pounds of funding should come from shareholders' pockets. Or the bank can also expand the lending and borrowing by setting up ABCP program. So it works like this. This is the original balance sheet of the bank. Having 100 billion pounds of loans, the bank can set up subsidiary company SPV and giving the high quality assets and loans to this subsidiary company. And based on those assets, the SPV can issue bonds called ABCPs to investors being paid by cash, and the cash can go to the sponsor bank, which can lend the cash to more companies and households. ABCPs are not insured by deposit insurance. And again, SPV is a subsidiary company, and the parent company has limited liability to the subsidiary company. So from the investor's point of view, ABCP are not safe enough, maybe not attractive, but no problem. The sponsor bank can give liquidity guarantee so that if the SPV has problem in reimbursing these ABCPs, it's guaranteed by the sponsor bank. The deposits of sponsor bank are protected by deposit insurance. Okay? And in this example, you can see that, well, technically the bank is lending only 100 billion pounds, but in reality, the bank is lending 125 billion pounds. And yet, the equity is only 8 billion pounds. So the bank is getting away with high equity requirement, and hence shadow banking. But shadow banking is not a criminal activity, okay? It's just less regulated version of banking. So that was the first example of shadow banking, asset-backed commercial paper programs. Now before the second example of shadow banking, let us do one preliminary, which is repurchase agreement, or repos. Repurchase agreement consists of two separate transactions: the original sale and purchase, and the subsequent resale and repurchase. So today, some financial institution sells, let's say this financial institution has some treasury bills which are worth 1.25 million pounds, and this institution sells the treasury bills to some other institution for 1 million pounds. Okay? The seller sells treasury bills to some other institution for 1 million pounds, and at the same time they enter into another contract which says that on the following day the original seller must repurchase the same asset for the predetermined price, let's say 1.0001 million pounds. Okay, so simultaneously they sign two contracts. The first contract says that the seller sells this asset for 1 million pounds. The second contract says that the seller should repurchase it on the next day for 1.0001 million pounds. Now, if you look at this carefully, you would notice that this is nothing but lending and borrowing using these securities as collateral. Basically, this institution is borrowing 1 million pounds using its treasury bills as collateral, and then by promising to repay 1 million pounds and some interest on the next day to get the asset back. The interest rate in this lending and borrowing is 0.01% per day, which is 3.65% per year. The interest rate for repo is called repo rate. There's another important term for repos, that's repo haircut. Repo haircut refers to how much smaller the borrowed amount is compared with the original value of the asset. In this example, the original value of the asset is 1.25 million pounds. The borrowed amount is 1 million pounds, and therefore the haircut is 20%, meaning that the borrowed amount is 20% less than the original value of the collateral. If the price of the collateral, if the price of the asset used as a collateral is very stable, then the required haircut can be very small. But if the price of the collateral is very unstable and has been very volatile, then the required haircut can be very large. Now, the idea of repo is not very new in human history. Something similar exists for a long time in history, and that's pawnage. When your grandfather was of your age, there was no credit card or consumer loans, so when he was really short of cash, he could, he took some of his precious items to a pawnbroker's shop. It can be a watch or jewelry or a set of encyclopedia, the real encyclopedia with 30 volumes, to the shop. And let's say his watch is worth 100 pounds, and using this one as collateral, he sells it for 50 pounds. But the deal is that if he comes back within 3 months and pays 60 pounds, he can get his watch back. So again, this is about lending and borrowing money using his watch as collateral. In this example, interest rate is 20%, the haircut is 50%. So both repos and pawnage are basically loans secured by use of some collateral. But there are many other loans that use collateral. How are these different from those, secured loans? Mortgage, for example. Mortgage also uses collateral. Repos and pawnage are different from other secured loans in that, before that, let me talk about the difference between the repo and the pawnage. Repo is recourse loans. So if the original seller fails to repurchase this asset, the lender can seize the collateral. Let's say the value of the collateral has dropped for 1 day, so that the value of the collateral is not high enough to cover the whole debt. Then the lender can take the borrower to court and demands the rest of the debt. So that's recourse loan. Most repos are recourse loans. Pawnage is non-recourse loan. Okay? So if your grandfather doesn't pay £60, then the shop takes the watch, and that's it. No more obligation. He just loses his precious watch. So it's non-recourse loan. That's the only difference. Now, how are they different from other secured loans, such as mortgage and car loans? Well, they are different in that it is the lender who keeps the collateral. For mortgage or car loan, while you are borrowing, you drive your car. Okay? While you are borrowing mortgage, you live in the house. It is the borrower who keeps the collateral, which is additional risk for the lender. The borrower might damage or lose the collateral. For repos and pawnage, it is the lender who keeps the collateral. So it's safer, a little safer for the lender. From the borrower's point of view, there's a little risk, the risk that the lender might lose or damage the collateral. Your grandfather comes back to the shop, and the shopkeeper says, "Oops, I didn't expect you would actually come back, so I have already sold your watch." And in that case, he would have to take the shopkeeper to court. Okay, but that's the only difference. Basically, okay, repos are loans secured by use of some assets as collateral. Now this repo can be combined with securitization as a means of banking, and that's called securitized banking. Securitized banking refers to the combination of securitization and repo. And it works as this. Consider an investment bank, let's say Lehman Brothers. Investment banks don't lend mortgages or corporate loans to companies or households. So Lehman Brothers purchases loans and mortgages from other banks by paying. I'll explain where this money comes from, but for now, just imagine that Lehman Brothers had some money, and using that money, it purchases loans and mortgages from other banks. Then, the bank can establish an SPV, special purpose vehicle, for the purpose of issuing mortgage-backed securities by giving these purchased mortgages to the SPV. So the SPV, based on these mortgages, the SPV issues mortgage-backed securities to investors such as pension funds and mutual funds, being paid by cash. And the sales can go to the sponsor bank, Lehman Brothers. So on the balance sheet of this SPV, mortgage-backed securities are their liabilities and their assets are the mortgages. The investment bank, Lehman Brothers, can also establish another SPV for the purpose of issuing collateralized debt obligations. Lehman Brothers gives some mortgages and loans to the SPV. It can get also mortgage-backed securities from the other SPV, and by pooling all these assets, the SPV issues collateralized debt obligations being paid by cash. Okay? And in this process, they can be credit enhancement, tranching. We studied them in details in the last class. So, and the sales go to the sponsor bank. On the balance sheet of this SPV, their liability is collateralized debt obligation. This is what the SPV owes to the investors. And on the asset side is the pool of various miscellaneous assets. This part is securitization, which we studied in details in the last class. Now, so far we haven't seen yet any maturity transformation. Loans and mortgages are long-term assets. Mortgage-backed securities and collateralized debt obligations are also long-term assets. Some investors buy such long-term assets. Some investors have long-term investment horizon, But not all investors buy such long-term assets. Many investors have much shorter-term investment horizon. Many investors want much shorter-term investment opportunities. To meet such demand, investment bank acquired some issued securities from these SPVs, particularly high-quality ones, and Lehman Brothers can use these high-quality asset-backed securities to borrow money from investors such as money market funds through repos. So they use these securities to borrow short-term, very short-term, overnight money from the investors. This part is repo, okay? So this purchase and repurchase of these securities every day. Of course, in reality, they do not bother to deliver the assets back and forth. These assets are securely stored somewhere, and the ownership is changed, renewed. This money is used to buy these loans and mortgages, and the circle completes. Investors keep investing in these repos, but they don't have to sign a contract every day. It's pretty much like you depositing your money in NatWest. Repo agreements can be renewed every day automatically until the investors stop doing it. Now this is banking because long-term assets such as loans, mortgages, mortgage-backed securities, and CDOs are funded. Such long-term assets are funded by short-term money from investors. So it also relies on investors' relay of short-term money to fund these long-term securities, assets, and as such, it is subject to bank run risk. Of course, it doesn't have to involve these investors actually running to the investment bank, but you know what I mean. If many investors suddenly stop investing in the repo, then you should also stop investing because this investment bank would have trouble. Long-term assets are funded by this short-term money. Okay, but this collateral makes the repo safe. Even if the haircut is large, the haircut makes this repo safe. Even if the investment bank defaults, you can seize the collateral, and usually haircut guarantees that the value of the collateral is high enough to cover the debt. Okay. So that's the second example of shadow banking. Repo is not secured by deposit insurance, but the haircut makes the lending, this short-term lending, safe. Is it okay? Yeah? Okay, so the last example of shadow banking, which is money market funds. I said main buyers of ABCPs are money market funds. Main investors of repos are money market funds. But money market funds themselves are a means of shadow banking. So this is how money market fund works. There is a sponsor, and the sponsor establishes a subsidiary. And the subsidiary issued some shares to investors being paid by cash. And this cash is invested in a variety of assets, including government bonds and agency bonds, and so on. So there are two types of money market funds that mainly invest in government securities, and money market funds that mainly invest in non-government securities. So the types of securities are diverse, but there is one thing common in these securities. These securities are all presumably very safe assets, okay, and relatively short term. Some of them have time to maturity 3 days, 5 days, 1 week, 1 month, maybe 3 months, but not 3 years. Okay, so they are relatively short-term securities. But still, this is banking because money market fund shares is very short-term borrowing. It's 1 day. The investors can withdraw anytime. So relatively longer-term assets are funded by very short-term money from investors. So it is a form of banking. Now, when we studied funds in week 8, I said, okay, buying a share of a fund resembles buying a share of a company that has a variety of assets. I said investing in a share of a fund is like investing in a company's share, the company that has a variety of assets. That's true for equity funds and the bond funds, but for money market funds, investing in a share of money market funds is more similar to investing in bank deposits than to investing in companies' shares. And that is because money market funds allow investors to withdraw their investment for $1 per share. So money market funds keep paying small dividends or interest to the fund shareholders to keep the share price exactly $1, $1. Okay, it's called net asset value. So the net asset value is kept $1, and investors can always withdraw their investment for $1 per share. It's like your deposit in NatWest. You deposit £1 in NatWest, you can withdraw £1. Yes, the same idea. For equity investment, that's not the case. For equity investment, even if you invest £1 in some company's shares, on the next day it may be 80 pence. Yeah? So investing in money market funds is pretty much like investing in bank deposits. Of course, if some of these assets decline significantly in value or even default, the price of the share of the fund may go below £1, and in that case, it is said that the fund broke the buck, is breaking the buck. That's kind of default. Okay, you deposit £1 in NatWest, and when you withdraw, it's only 80 pence. That's bankruptcy. However, in the history of money market funds, okay, there are many money market funds in the United States. Prior to the 2007-2008 financial crisis, there were only a few cases of money market funds breaking the buck, and that is because their sponsors give implicit guarantees. Sponsor banks care about their reputation. If their fund breaks the buck, they may never be able to attract investors in the future, so sponsors give guarantee to make sure that money market fund investors will be fully paid. And that's the third form of shadow banking. Okay? These stories are very unreal. Doesn't sound real or interesting if you don't know many stories, actual stories. So I really recommend you to watch, before week 11 lectures, please watch that 10-minute introduction video to 10-minute introduction to financial crisis, and also please watch that excellent film Inside Job before week 11 lectures. And then please, if you haven't done so yet, please buy and listen to the audible version of Adamati and Helwig's book. Okay, these things will give you actual examples, and you will understand more clearly how these things work and how they can go bad. Okay, so the name of this module is Money and Banking, but we didn't study much about money. So our plan is to spend the next half an hour to study money. And I think the best suited topic for that is the goldsmith anecdote. So this is the origin of banks and banknotes, okay? So once upon a time, people used to use precious gold and precious metals for their transaction. So there's farmer, baker, and cook. They are all rich, and they use precious metal, gold, in their transaction. However, gold has, holding gold and transporting gold has both security problem and the convenience problem. They are too precious and too heavy. And here comes the role of goldsmith. Goldsmith has already got a very secure building and tight, very, security, lots of security men. So the goldsmith can offer the place of storage for other people. So other people pay some fee to keep their gold safe, nice and safe in the goldsmith's warehouse. And the goldsmith issued some warehouse receipts that say that their gold is securely kept. Now at the beginning, when the baker buys something from the farmer, the baker goes to the goldsmith, shows his receipt, gets his gold back, pays to the farmer by gold, and then the farmer goes to the goldsmith to leave the gold, getting receipt. But from some point, they started to think, why are we traveling between our places and the goldsmith's warehouse back and forth? Do you really need gold? I mean, I can get gold and pay you by gold, but then you would have to go to the goldsmith to store the gold. I can give you this receipt. Can I pay by this receipt? If you want, you can go to the goldsmith to get gold. So they started to use the receipts as a medium of exchange. As long as this goldsmith is trustworthy, it's fine. These notes, these receipts perfectly work as a medium of exchange. Now, much fewer people actually come to the goldsmith warehouse to get their gold back. So goldsmith thinks, well, now not many people come to get their gold. A large proportion of gold is simply sitting in the warehouse. So maybe I can lend out some of the gold to other people to earn some fees. So the goldsmith can lend out a small proportion of the gold to other businesses, entrepreneurs, to get some interest income. Now some interesting change has occurred at this point to the economy. Before, the amount of money circulating in the economy was the amount of gold. Now, the amount of money is the amount of gold plus the amount of receipts circulating in the economy. So the amount of money has increased. Because that's the beginning of the gold standard. So under the gold standard, the government gives permission to some goldsmiths or banks, and the permission to issue receipts that can circulate as money. And under the gold standard system, such receipts are called banknotes. And if people take those banknotes to the issuer bank, they can get gold. These banknotes are convertible to gold on demand. Of course, these banks cannot lend out all the gold they have. They should keep some gold as reserve, just in case more people come to the bank to get gold than expected. Now, in principle, all notes should be convertible into gold, but people may have their preference. People may prefer some notes, banknotes issued by some banks to other banknotes. Okay, especially people may be unwilling to accept banknotes issued by a bank that they have never heard of. Indeed, in the United States, until early 19th century, banknotes circulated only in a small area surrounding the bank. So maybe people in Pennsylvania didn't accept banknotes issued by some unknown bank in Virginia. So banks started to make a voluntary arrangement to make the circulation of their banknotes, wider. And the following is the arrangement. Okay, let's say this bank A is in the urban area, and this bank B is in a far place. Under this arrangement, bank A keeps some gold within bank B, and let's say this person in the urban area and this person in the countryside make some transaction, and this person in the urban area pays by banknote issued by bank A. The seller takes this note to bank B to get gold, and then bank B takes this note to bank A to get gold. If bank A fails to do that, bank B can simply seize this bank A's gold within itself. Under this arrangement, this person accepts bank A's note, believing that bank B will accept this note, and bank B accepts this note, believing that bank A will accept this note. And in this way, the circulation, the money, the banknotes can circulate in the wider area. So the liquidity of banknotes go up. In most countries, eventually the government or the central bank became the sole issuer of banknotes. So other private banks stopped issuing banknotes, but in some areas, still other banks also issue banknotes. This is a £10 note issued by Clydesdale Bank in Scotland. I think in Scotland there are three banks that issue pounds. And this is a $20 bill issued by a 20 Hong Kong dollar bill issued by Standard Chartered Bank. Okay? But in most countries, the central bank is the only issuer of banknotes. In 1930s, countries stopped gold standard, so people can no longer convert banknotes into gold. In developing countries with unstable political system, that would be a problem because politicians might print as much money as they like. But in developed countries, it's okay. The people have been using these notes for a long time without actually converting into gold. Now you might think, oh, okay, so the gold standard is over. Then what's the point of learning this goldsmith anecdote? It's just about learning history. Well, in a sense, banks today are doing something similar to these goldsmiths in the anecdote. Okay, banks today are also doing something similar, and to understand that, you should understand that bank deposits are also money. So here's the modern version of goldsmith anecdote. Farmers, bankers, cook, they don't have gold, but they have British pounds. But, they have security problem and physical problem. No one wants to carry 100,000 pounds in their wallet. So they deposit their cash in the bank. The bank issues receipts called bank accounts. And the bank lends out some of the cash to other businesses. And still, these people can use these accounts as a medium of exchange. They can write a check. They can use debit card. They can use direct debit. So they don't need cash. They can still do transactions. The only difference, the story is very analogous to the goldsmith anecdote. The only difference is that instead of gold, we start with banknotes. And instead of receipts, the bank issues bank accounts. The result is the same. The total amount of money existing in the economy is not just notes and coins. It's cash. The total amount of money in the economy is cash plus bank accounts. Here, in today's class, by money, we mean something that can be used as a means of transaction, something that is useful for business activities. I mean, transactions in business. So that's the point. Money existing in the economy is not just banknotes and coins. For example, the check account, debit account is also money. Yeah? Because you can use it as a means of transaction. Saving account is also money-like. Okay, it's less money-like than debit account because you cannot write a check with your saving account. But still, you can. I think in UK you can still have a debit card-like card with saving account, and you can also send money from your saving account to other people. And in the worst scenario, you can say, "Oh, please wait a minute and go to the ATM and withdraw cash and pay by cash." Okay, so saving account is liquid enough to be called money. So it's less saving account is less money-like than check account, debit account, but still more money-like than other assets such as long-term government bonds. Here, the keyword is liquidity. If the asset has high liquidity, it is money-like. So here comes the dichotomy of macroeconomics. If you remember what you learned in the first year macro, you are taught, okay, there is money and asset. Money is for transaction purpose. Asset is for saving purpose. Money doesn't give you any interest, but it's useful for transaction. Asset gives you some interest revenues. So its asset is for saving, it's suitable for saving purpose. In reality, there is a variety of fixed income assets. So I just, in this diagram, I kind of half randomly put many fixed income assets and land in this one-dimensional line. But the idea is that if you go left, assets have high liquidity, but doesn't give you much interest. If you go right, they don't have high liquidity, but you can earn relatively high interest. And you can say, okay, these are money and these are assets. So the idea is that asset gives you interest revenues and hence suitable for saving. Money doesn't give you much interest but has high liquidity, so it's convenient for business and transaction. Of course, there is not clear threshold or boundary between money and asset. And indeed, there are several definitions of money such as M0, M1, M2, M3. The narrowest definition of money can be just cash, notes and coins. And the second narrowest definition of money can include cash and debit account. The next definition, a slightly wider definition of money, can include cash, debit account, and saving account. And the next definition can include cash, debit account, saving account, and maybe bank CDs. And the next definition can include money market funds. By the way, you don't have to remember these definitions, this M0, M1, M2, M3. These definitions are different depending on the countries, so UK, US, Germany, and Japan, and your countries can have different definitions. So you don't have to try to remember these M0, M1, M3, but you should understand the idea. Okay, some assets are more money-like, other assets are more asset-like, and depending on, the definition of money you want to use depends on your purpose of analysis, okay? Sometimes you want to focus on a very narrow meaning of money, sometimes you want to include many other things in money. Let's call it a day. Thank you for coming, and I'll see you next week.